Welcome back to my video. If you like my video, please don't forget to like and subscribe and comment. If you have any questions, I answers all the question pretty much, and if you want to see any specific video, just let me know and I will make one. Anyway, today we're going to talk about risk management, portfolio diversification. A lot of people are kind of confused about like how much they should day trading, or they should just do day trade or long-term portfolio, or how much they should put in a stock, or in a trade. So a lot of people are kind of confused, and what a lot of people are doing is like they're putting their whole money in one stock, and kind of their account are getting wiped up. So they kind of have don't have faith. The thing is like stock market is really awesome tool to generate wealth, but you need to get it right. You need to do it correctly. If you don't do it, you will lose money. So I think discipline is key, and you have to really have a proper risk management and a portfolio diversification. So a lot of people are questions like what's day trading, what's swing trading, what's long-term investment, right? So day trading is basically, right, like maybe 1 to 2 days that mostly you are buying a stock or options and selling on the same day. That's day trading. That's day trading. Swing trading, you are basically buying stock or options and holding from few weeks to few months. It could be couple months out, or couple weeks, depending upon, I don't know, whatever you are trading up, maybe some news, or some news they had a great earnings, or maybe their chart set up perfectly, or whatever it could be. Those are the swing trade, basically from weeks to few months. Long term investment, basically you buy it and kind of sleep, don't look at them. I mean, if they are really down, maybe you can add or some things, or if they going downhill and you don't see any future, you may get out. But basically most of the time long term, you just don't even look into them. A lot of people are saying is like, oh, long term, that's very slow, the returns are very, not as attractive as 10, 20, 40, 50, 100% you see. But the thing is like nobody can get like even 10, even 5% daily consistently. If somebody could get that, he would be the richest person in the earth. That's impossible. That's mathematically impossible. The thing is like you can do with a small account, but as it grows larger, it's impossible. You cannot do it. So best thing is you always need to have long-term investment. So I'm kind of going through, let's say you have a portfolio, right? So you should always do your day trading should be the smallest one, maybe 10%, 20% if you have really small account and you want to kind of play the grounds and see like that. Swing trading, 20 to 30%. A little bit you have wiggle room, you have some few days, so if you're doing options or even stocks, you have a little bit of time, so you do that. Now you have a long-term investment. This is where you should put your majority of portfolio. Your most of your portfolio should be in a long-term investment. I would say like 60 to 70 or 80%. Even 60 to 70, that sounds like I have 80, but yeah, just you get the idea. Majority should be in long-term. A lot of people say that's slow, but I'm gonna show you exactly. You can actually make millions by just buying and holding a long-term portfolio. If you look at this is the calculator like I got of investor.gov, and you can put it, let's say you are like 20s, right? So 20s, and let's say 20, that's not even like, that's pretty good. 20, you can probably like put initial investment of thousands, and let's say you can put monthly contribution of 500. That's like a car payment. I mean, if you literally just use your used car and put $500 every month, see how much you can make in 30 years. So I put the estimated interest rate as 20%. So basically I based this off the Berkshire Hathaway, which is historical returns of about 19 per something. So I could put 19, but I just put it 20 for round up easier, and I'm just compounding annually. So if you compound annually, if you look at that, in 30 years your money will be $7 million. Yes, that's right, $7 million. And this is slow process. You don't have to bash your head. You can just do very slowly and you can get this return. This is fact. This is historical fact. Even if you say SPY, right, 8 to 10%, and if you look at the SPY, that's historical return, you can still get with like 161,000. That's, oh sorry, I think I put change it like years was 30 and estimated was 10. So if you do that, you can still get away with $1 million. So literally you can put in SPI 500 a month, in 30 years you'll be millionaire. You can actually significant. And I think like a lot of people, you don't even have to make six figures. You can, a lot of people, if you have decent job, you could probably save $500. If not, you probably need to find a way to save that. I mean, that's important. But look at that, you could literally make $1 million with just the SPY as well. Now, let's look at the, let's say this is mostly for the day trading. For long term investment, you have a little bit of wiggle room. So I would say like max go 10 or 20%, max 20%. I usually go 10 to 15% for one sector. Always diversify, right? Within your day trading portfolio, diversify. That way, like let's say you, if you put like whole portfolio in one trade, if it goes south and you lose all, you lose all. You should not lose all. You should always use stop loss so you can manage your 10-20% rather than losing all. But um, even if, right, like even if you, let's say your day trading whole portfolio you got just 10% wiped, you still have 90%. So if you do that, that's always. So what does how much you should put in a trade? That's another questions I get a lot. So how much you should put in a trade? So basically you are day trading, right? So the more money, more capital you have more wiggle room. For less capital, I would say you may need to increase your percent. But as an example, let's say there's, you have 1,000, this is the amount you have. Let's say you have $1,000, you could literally go up to maybe 5 or even 10%. I would say like 50 to 100. So yeah, I would say 10. It's fine if you have $1,000 up to 10%, but not more than that. That way, even if you lose, you still have like 90%, or you have been other place. And the other thing is like always cash. You should always have like 40% cash or something. You need it because when you have March or April low, if you had a good cash, you could actually buy back. You will get opportunities. Like a lot of people says like, oh, it's going up and up. If you look at the silver, right? Yesterday we had a massive red day with 10 or 12% down, and today if you look, they're back up like 5 or 6%. Those are the opportunities if you believe in the ticker or ETF or whatever it is, right? If you believe in the equity, you buy on the red day. When there's a fear, you buy it. So yeah, so if you look at that, if you have 100,000 account, you can do like 5,000 a trade, and if you lose two, you lose 5%. And again, like I'm saying again and again, if you lose stop loss, you will not lose. You lose like what? You lose like 20% of 5%. So that's like the 1% of your portfolio. So see um, how it makes sense. And other questions I get a lot is like, okay, in long term, I think ETF is way to go for long term portfolio, and a lot of people are like, hey, ETF don't. The thing is like, there's a lot of ETF which are really high growth too. For example, I have like this Vogue. If you look at that, Vogue literally in 2021 it was around 50. So it's 206 now. So that's almost 400%. So within like what within 10 years span, it's 400%. That's awesome return. I mean, if you can match that, I mean, I would invest in you. All right, that's it for today. If you have any question or comments too, please comment below and like, subscribe, and adios. Thank you.